Okay, so we are wrapping up on, I believe it's chapter 16. Well, actually, kind of in the middle of chapter 16. We've got another couple handouts, but we're wrapping up the handout from last Tuesday. If you ended up downloading early some of the files, you may note that there's two of these included for the next two. So you'll see on handout 14 this, but you'll also see it on handout 15. However, I corrected that. So you guys won't have that here. Somebody asked me if there were questions about the exam. If there's one that you think isn't right or unfair or just need some guidance on it, just take a screenshot of it and send it to me, and I will break it down for you and send it back and make an adjustment if necessary. So we're still talking about investments. And we're in investments for equity securities. So we talked about bond securities in the last class. And what we have here is how equity investments are accounted for. Now, keep in mind that you can always use the fair value method, but in general, companies that choose to use the standard accounting, when they hold less than 20%, you look at how much influence they have, how much control do they have over the company. And so the FASB has said less than 20%, 20 to 50%, and over 50%. But you can own less than 50% and still have to do equity. And the way that they usually decide it is, do you share members of the board? Are you able to put members on the board on your own? And that gives you some control. So keep in mind, while this is the general rule, it's not hard and fast. All right. So for holdings of less than 20%, it's assumed that the investor has a passive interest. And so we're going to use the fair value method to account for this investment. Holdings between 20 and 50%, we're going to use the equity method, and the investor has a significant influence. Holdings of 50% or more, the investor has controlling interest. And this is covered in advanced. I'll give you guys time to write that down. So we're going to talk about holdings less than 20%. So we're going to use the fair value method. And when we purchase securities, we're going to debit equity investments and credit cash. When we record dividend income, we debit cash and then credit dividend revenue. Now, not all stocks pay dividends, so some you'll never have dividend revenue from, but the ones that do, that's how you record it. At period or year end, record an adjustment to fair value. So the entry for a fair value loss would be to debit unrealized holding gain or loss. Income account. And then credit fair value adjustment. At period or year end, record an adjustment for fair value gain. Debit fair value adjustment. And credit unrealized holding gain or loss. Income. So remember, when you're valuing them with fair value, the unrealized holding gain or loss goes through your regular income statement, whereas sometimes the case with bonds, you'll have it go through other comprehensive income. Any questions so far? Upon sale, compare the proceeds to the amortized cost. And so you would debit cash. And if you had it, you'd have a loss on sale of equity investments. Bless you. And then you would credit equity investments. And you would credit gain on sale of equity investments, if applicable. We want to note here that companies do not adjust the fair value adjustment account upon sale. A new assessment will be done without the equity investment at period end. Kind of see which example we've got. Next. So we got example 7. Okay, it says Woods Company purchased 80,000 shares of Holmes Corporation common stock for $1,260,000 as an equity investment. The fair value of these shares was $1,200,000 at December 31st, 2020. Woods sold all of Holmes stock for $17 per share on December 31st, 2021, incurring $56,000 in brokerage commissions. Woods Company should report a realized gain on the sale of stock for 2021 of, so we have to say, okay, what did we sell them for? We have 80,000 shares times 17 equals $1,360,000. And so to get net proceeds, subtract fees. And so here we have minus 56,000. Put the comma in the wrong spot there. And so $1,244,000. Check my math on that. Nope, 1,304,000. Less the cost, 1,260,000. And so the total gain would be 44,000. Any questions there? While you guys are doing the practice 2 just below, I will make an entry for this. That it wasn't required, but you guys can work on that for a few minutes and I'll do this. Okay, so this one's relatively straightforward. We have a $45,000 loss and a $20,000 gain. So we would report $25,000 loss, or C. Okay, any questions? We still got more of these to do. So now we're jumping to the other handout. Okay, so we have this version, and that should be passed out, and it's also available in the modules. And so I'd like you guys to take about 5 minutes to answer the questions. Bless you. Okay, so let's go ahead and go over these. Cohen Corporation accounts for its investment in the common stock of Sells Company under the equity method. Cohen Corporation should ordinarily record a cash dividend received from Sells as, and this one is a reduction in the carrying value of the investment. Judd Inc. owns 35% of Cosby Corporation. During the calendar year 2021, Cosby had net earnings of $300,000 and paid dividends of $30,000. Judd mistakenly recorded these transactions using the fair value method rather than the equity method account. What effect would this have on the investment account, net income, and retained earnings, respectively? And so the answer is D, understate, understate, understate. Dublin Corporation holds a 30% stake in Club Company, which was purchased in 2021 at a cost of $3 million. After applying the equity method, the investment in Club Company account has a balance of $3,040,000. At December 31, 2021, the fair value of the investment is $3,120,000. Which of the following values is acceptable for Dublin to use in its balance sheet as of December 31, 2021? So we have one, 3 million. So we're either going to be valuing it at fair value or equity method, so it's not going to be that. The 3,040,000 would be okay, right? Because that's under the equity method. And then the 3,120,000 would be okay because that's under the fair value method. So the answer for number 3 is also D. When an investment in a held to maturity security is transferred to an available for sale debt security, the carrying value assigned to the available debt security should be, it's not its original cost, but its fair value at the date of transfer. So remember, historical costs are for things that we're not holding out on our balance sheet to sell. We're either going to hold it till it matures and we have no plans to sell it. Gains trading involves selling the securities that you have gains on. So that is C. You might hear that talked about in your tax class. If you had some losses that year and you want to take some gains, you sell the ones that had gains on it and they can be reduced by the gains get offset tax basis by the losses. Okay. So we have examples 1 and 2 here that I'm going to walk through for Harrison Company. So it says Harrison Company owns 20,000 of the 50,000 shares of Taylor Inc. common stock during 2021. Taylor earns 1.2 million and pays cash dividends of 960,000. If the beginning balance in the investment account was 750,000, the balance at December 31st, 2020 should be. And so what we're going to do is we're going to say, okay, we had an initial balance that was 750,000. We're going to add our portion of the income. And so this is going to be 1.2 million minus 960,000. And we're going to multiply that by the share 20,000 divided by 50,000. That's the number of shares that we own. And we end up with 96,000. And so our ending balance equals 846,000. Example 2, Harrison should report investment revenue in 2021 of, and so we have 1.2 million times 20,000 divided by 50,000 because that's their percentage of the income. And that equals 480,000. Any questions there? Okay, now we've got some practice questions for you. The information is given as follows. And the first one asks, the amount of the debit to equity investment for Dobbs would have been. So this one's relatively straightforward, I hope. All you're saying is, what did we pay for it? And so we spent 350,000. So our entry, debit to equity investments, 350,000, credit to cash, 350,000. Okay, you guys try number 2. Okay, so practice 2 is relatively straightforward as well. When you purchase an investment, you record it at that purchase price. And so practice number 2 is also the purchase amount, which is 430,000. Okay, take a minute, look at number 3. Okay, so this one is a bit of a trick question. It says if the Gable Company acquired 20% interest in Dobbs 20% is usually accounted for using the fair value method, right? So the net income of 150,000 and cash dividends of 60,000, we would report some of the cash dividends that we received, but when we apply the fair value method, it would not change the balance in that account. And so we don't have any information that says it would change. So the answer is 290,000. So I'll give you guys about 5 minutes for this one. It's a little bit more complicated. You guys can talk to each other. If you have questions, you can ask me over. I'm happy to help. Hey, you guys look ready or bored? By the way, time to move on, right? Okay, so we have our beginning investment, and that's 440,000. And then we have to add our portion of net income. And so this would be 150,000 times 0.3, because our ownership is 30%. And so that's 45,000. We have to deduct dividends received. So they paid out 60,000. And our portion of it was 30%. And so that's 18,000. And so our ending balance investment is our total 467,000. Any questions on this handout? So what you'll find on the rest of this is that I've carried over some of these things so that you can just look at these. And all it is a summation that we talked about. Now, companies can choose to use the fair value for all investments, and transfers from one type or another occur at fair value. And so this will help you with any of that information. And I know I don't feel like we covered enough in this chapter, so I've got another handout there for you with some questions that we're going to go through that are a little more comprehensive. And so if there's no other questions, we'll go to handout 15.5. I think I called it 11.5, but it should be 15.5. Okay, so we have two different situations, and they're independent, meaning they have no relationship to each other. Everybody has a copy of this, right? Okay. I can give you a paper version. There should be an electronic version out there, but no problem giving you a paper version. Okay, it says People Tables acquired 15% of the 5 million shares of common stock of Robot Sofas at a total cost of $8.50 per share on April 1, 2025. On August 8, Robot Sofas declared and paid a $250,000 cash dividend. On December 31st, Robot Sofa's market price was $9 per share, and the company reported net income of $685,000. Okay, so under the first one, we have a 15% stake in it, which gets recorded at fair value. And so this would be 4/1/25. And we have equity investments. And cash. And it said that we purchased 15% times 5 million. And that gives us 750,000 shares at 8.5. And so that's 6,375,000. Okay. So now, it's a little bit of my answer key here. Give me 1 second. I cut out part of this to record, so you'll have to write it in. Dividend revenue. And so you would debit cash for 37,500, and you would credit dividend revenue for 37,500. And you calculate that, the 250,000 times 15% equals 37,500. Okay, now it says that the market price was $9 per share on December 31st. And so we have to record the investment at the fair value. And so we have fair value adjustment. And then a credit to unrealized holding gains or losses. And how do we calculate that? We had 750,000 shares, and they went from 8.5, we recorded them at, to $9 per share. So I only want to record the change here. So I'm going to take the 9 and subtract out the 8.5. And I'm going to multiply that out, and that's 375,000. So the debit 375 and the credit 375,000. Any questions there? Sorry about the formatting issue there. Okay, let's take a look at scenario number 2 or situation number 2. On January 1, 2025, MICA Corporation purchased 40% of Sanders Corporation's 500,000 outstanding shares of common stock at a total cost of $13 per share. On October 25th, Santos declared and paid a cash dividend of 40 cents per share. On December 31st, Santos reported net income of $860,000 for the year, and the market price of its common stock was $14 per share. So now we're going to be accounting for it using the equity method. So this isn't important to us, but we do care about the net income. We also want to record it properly, and we want to record the dividend. So this is 1/1/25. And we have equity investments and a credit to cash. And so we have to calculate how much. So they have 500,000 shares, which we got 40% of at $13 per share. And so that total is 2.6 million. So we have a debit of 2.6 million and a credit of 2.6 million. Okay. To record the receipt of cash dividends, this was 10/25/25. And so we're gonna receive cash. Oh, I don't know why I keep typing that G in there. Cash, and it's gonna be 500,000 shares times 40%, which is our ownership. And they said that they paid 40 cents per share. So we multiply that by 0.4 again. And we end up with 80,000. Now for equity investments, this reduces our basis. And so sometimes this is a difficult one to remember, but you have to reduce the basis because it's like a return of capital, a return of your ownership stake. And so you you credit equity investment, which reduces the amount you have invested in that equity investment on the books anyways. Doesn't change the actual purchase price. Any questions there? Okay, now we're gonna record the 40% of the income, so 12/31/2025. And so we have the description. This is gonna boost back up now our equity investment, as long as they make a profit, right? And the credit is gonna be to investment income or revenue. And we take 860,000 and we multiply by 40%. And that equals 344,000. So our debit 344 and our credit 344,000. Any questions? Okay, let's take a look at example number 2. And in part A, it says, what entry would Tomlin make at December 31, 2025 to record the investment in Azul company stock if it chooses to report this security using the fair value option? So we've already got it on our books. It was invested at 20 or 200,000 and its current fair value is 221,000. So we look for our entry for gain. Oh, I'm sorry. This is a equity investment, right? Oh no, but they wanted to record it at fair value. All right. So equity investments. That's going to be our debit. And that amount, 21,000, is going to be the difference. And then we have unrealized holding gain or loss for 21,000. And that 21,000 is the 221 market value minus the 200,000 cost. It says, what entry or entries would Tomlin Company make at December 31, 2025 to record investments in the Justin and Tiger corporations, assuming that Tomlin did not select the fair value option for these investments? Okay, so now we've got investment in Justin and investment in Tiger. So if they did not select the fair value option for these investments, and so for part B, we'd have fair value adjustment. And a credit to unrealized holding gains or losses. And we go back up and we calculate. So for Justin Corporation stock, it's 285 minus the 271,000. And then for Tiger, 260,000 minus 185,000. And there's these 4 boxes are where I got those values. And so that's 14,000. And I think that's 75,000, if my math is right. And so our fair value adjustment, adding the 2 would be 89,000, and the gain would be 89,000. Any questions there? Bless you. Your head blows off, you're gonna get stuff all over Emily. Okay. So it says blank company acquired 25% of the 500,000 shares outstanding common stock of Overload Inc. On December 31, 2025, the purchase price was $3.6 million. Overload declared and paid $1.20 per share dividends on June 18th, 2026, on November 29th, 2026. Overload reported net income of $1.2 million for 2026. The fair value of Overload common stock was $27 per share at December 31st, 2026. So we want to prepare the journal entries for blank company for 2026, assuming that blank cannot exercise significant influence over Overload. Okay, so what happened on June 18th, 2026? We got dividends at $1.20 per share. And we're not recording it using the equity method, so we're going to be able to record dividend revenue. So our cash, and we have to calculate 500,000 shares times 0.25, which is the percentage of ownership, and then times 1.2, which is the amount of the dividend. And so that's going to give us 150,000. And we'll have dividend revenue of 150,000. Same dividends again on November 29th. And so there is no change there. December 31st, 2021, we're gonna have to make a fair value adjustment. And so we've got $27 per share at December 31st, 2026. So and we're going to multiply that by the times the percentage ownership. And that's going to give us 3,375,000 on December 2026. And so we end up with an unrealized holding loss, but we still put it in gain or loss account, which flows through income for, what was our asset recorded at? Purchase price of 3.6 million. And so we have 3.6 million. And I like to put this in the other way. So the current value now, 3,375,000 minus 3.6 million. So that equals 225,000 negative. And so that's a loss. So we have 225,000. And then we have fair value adjustment for 225,000. Okay, part B says, prepare the journal entries for blank co for 2026, assuming that blank can exercise significant influence over overload. So now we're moving to the equity method. And we've already recorded it. And so we're going to record our dividends now on June 18th, 2026. We're going to get cash. And we know that that's 150,000 because it's still calculated the same. But now dividends are going to reduce our equity investments by 150,000. And the same thing is going to happen in November. Okay. And then at the end of the year, now we're recording not a fair value adjustment, right? But we're going to record our portion of the net income. And so we're going to have equity investments and investment income. And that's going to be the 500,000 shares times 0.25 and times our net income. Actually, I don't have to use the shares in this, right? Because it's not given as per share. So I just need 25% of 1,200,000 net income. And that's 300,000. Okay, and then part C. Part C says that what amount in the investment in securities reported on the balance sheet under each of these methods at December 31st, 2026? What is the total net income reported in 2026 under each of these methods? So your fair value method, you have the investment amount. And this is at 12/31/26. So we have 3,375,000. And under the equity method, 3,600,000. And then dividend revenue. Right, and you only report that in the fair value method. So we have 150,000 times 2. And so that's 300,000. And then we have unrealized holding loss, 225,000. And then investment income would be 300,000 because it doesn't apply for the fair value method. Any questions? Okay, so we've got a few minutes left in class. I think some of you are still kind of typing there, so I'll just leave that up. And we have the group problem for chapter 16. What I'll do is I'll give you guys 15 minutes in class here and then 15 minutes in class on Thursday. But you guys have to make sure that you are prepared and ready to go within those 15 minutes on Thursday. Okay, thank you. And of course, you can ask me any questions, beforehand. I may or may not answer them all, but that is it for today. And I think we start chapter 12 on Thursday, but I'll confirm that. All right, for those of you that are on the recording, it's going to stop here and we'll pick up on Thursday with a new chapter.